Welcome, everybody, to another episode of the Good Deeds Note Investing Podcast. I am one of your co-hosts, Jamie Bateman, flying solo as a host today. Hope everybody's doing well. I'm joined today by Jason DeBono from NuView Trust, and we're going to get into some of what Jason's background is and what his company offers. Jason, how are you doing today?
I'm doing well. Thanks for having me.
Yeah, absolutely. So like I said, why don't we just dive right into your background? Why don't you tell us a little bit about your personal history and how you got to where you are today?
Yeah, happy to. Self-direction for me started a little over 15 years ago, certainly more by accident than by design. I was a student at UCF here in Central Florida, and I was wrapping up looking for some internship kind of slash job experience as I was getting to the end of college. And I stumbled upon an internship expo and a handful of companies, and I interviewed with NuView. And it was really the reaction from my dad that caused me to kind of go, this is a good opportunity. When I talked to my dad before the interview, he told me, well, you can't really do this. It's not allowed. I've asked my advisor about buying real estate in an IRA, and they told me you couldn't. So the interview was more of a presentation for me and a learning opportunity. And when I called my dad and said, hey, this company does this, and this is why you haven't heard of it. He said, man, I wish I knew about this 5 years ago.
Yeah, so
And
it
I kind of
was
realized,
less of a hypothetical and more of a, no, this is happening. People do this.
yeah. Well, and it was nice to hear my dad. My dad's a typical baby boomer. He's not rich. He's been self-employed, worked his tail off his whole life, but he's always invested into real estate, loans and other things outside of what he did day to day.
Mm-hmm.
And so, when he learned he could do what he's already doing to earn money and get out of the kind of rat race of the stock market, he jumped all over it. And, I took the job, namely because I liked the opportunity after kind of seeing it through the lens of my dad. And here we are, almost 16 years later.
Okay, so where are you 16 years later? What do things look like right now?
So when I started, NuView was 3 years old as a company, really two and a half. We have grown to, we had about $60 million in assets. We've grown to 1.5 billion in assets. We have two different divisions in the company, and everything that we do is gives clients choice. Every one of our accounts, every dollar of the $1.5 billion is completely self-directed. We don't provide investment advice or recommend or endorse or approve investments. So, and it's testimony to the fact that we have a great team, but it's even more testimony to the fact that the marketplace and people just like you, Jamie, and people listening today are all going, there's got to be a better way to do this,
Mm-hmm. Absolutely.
especially with where the market is right now. I mean, the market is at an all-time high, and while everyone's
Yeah.
happy about it, there's not many people that go, this makes sense.
Right.
We're taking the profits, but it just doesn't make any logical sense in the midst
No.
of the
Yeah,
pandemic.
I agree. The stock market seems a little bit out of touch with reality, disconnected from the economy, frankly. Again, I'm not giving investment advice either. I'm not completely anti-stock market myself, but I really agree. It absolutely feels frothy, shall we say. And personally, I can say that I love just the topic of taking control of your finance, your personal finances, your wealth. And my wife and I have self-directed accounts, and I'm absolutely all about alternative investments and taking control of those, of your future, as opposed to kind of having somebody maybe babysit your funds over here and just hope and pray that it does well. So I think that your company can play your company and others like it can play a large role in that kind of strategy. So if you don't mind, briefly back up a little bit, and you mentioned before we started that you personally have done some note investing and some different investing that may tie into NuView as well. But how have you used kind of alternative investing in your own personal investment portfolio?
Yeah, so for me, I was a college kid when I started. I was learning, but I didn't have any money. So the only place that I was putting money was my 401k.
Mm-hmm.
I understood the tax power, and we can talk about that here in a bit about what that really means from a tax standpoint. But I was putting money away, and I was kind of living vicariously through customers. I mean, I was watching them do these deals, and the more and more people I talked to that did notes, the more and more I realized, while real estate is great, and I do invest in real estate, and I think it's a great investment, there's something to be said about passively collecting a check every single month with security.
Mhm.
And so I started when I didn't have much money in my account. I started doing small partials with other people that I knew, or would buy fractional interest, 2%, 5%. And I just kept doing that. As I was adding money, I was buying more. As I was adding money, I was buying more, and then they'd pay off and I'd combine. And so, it has served me incredibly well. And I've done some different things with the money over the years, but I would say probably 80% of the investments I've made in my own accounts over the last 15 years have all been notes.
Nice. Well, I have some partials to sell you if you want to talk.
If the numbers work, I'm always looking to buy.
Anyway, no, that's great. And I don't know. I mean, I do generally, again, not investment advice, but personally, you know, debt investing doesn't have any inherent tax benefits. Note investing, everything has downsides, right? And note investing doesn't have the tax efficiency, if you will, of traditional kind of buy and hold real estate, and you don't get that depreciation. So personally, I like doing the same thing, where it's more of I'll buy first lien performing notes in my self-directed account, and or partials as well. More of that passive, way to go, but also taking advantage of the tax benefits of the accounts. Whereas real estate can get a little bit tricky. I know it. I know people do it. I don't personally do it. I prefer to own real estate outside of these type of accounts, but we can get into that. So then NuView, now you touched on it, but I guess where are you today, and what's the future look like for NuView as a business?
It looked, the future, I think, for self-direction is a lot like it's been over the last 15 years, even through the Great Recession, in 2007 and beyond. People want alternatives. And the only thing that's really changed in what we do is simply the attractiveness of various asset classes based on time. There was a period where gold was what everyone wanted, and there was a period where it's been real estate. There's a period where it was private debt and private equity, and we're seeing cryptocurrency. And that's really where the changes come from us, is a little bit more in terms of what people are interested in. But self-direction as a whole, thankfully, is continuing to grow, and more consumers are realizing two key factors. One is building wealth is something that's their own responsibility, and
Mhm.
doesn't mean you can't hire people to help you. I can hire people in the real estate world and in the private note world and pay them a fee to help me make money, just like I can pay an advisor in the stock market to
Mhm.
help me make money. But they're realizing that if they want to build wealth, they've got to do it themselves. And the second thing is they're realizing that there's a lot of wealth and money to be made outside the stock market. And so with education available, with podcasts like this, I mean, the average consumer 15 years ago when I started had very little opportunity to understand what self-direction is.
Mhm.
Today, you don't have to go far. You don't have to leave your house anymore to understand that self-direction is a tool, and you can join groups and meetups and online stuff. Even pre-COVID, you could do all of these things and really go get educated on being an investor. And I think as that continues to play out,
Mhm.
as not just the millennials, but the Gen X, the Gen Y, whatever the next group behind it, the Reddit groups,
Right.
the Wall Street bets. I mean, all of these groups, they're all realizing, hey, we're going to take control and go make money.
Mhm.
And while some of those tie into stocks, a lot of them are doing a lot more investing outside the market too. And all of that is leading to an influx in people wanting to be in self-direction.
Yeah, that makes a lot of sense. And just in the time that I've been in real estate and notes, I've seen a similar kind of increase in the awareness and
Mhm.
the, I guess, motivation to take control, and the education is there, like you're saying. But it still does seem to be a kind of a small niche. I still think there are a lot of people that don't even know what a self-directed account is. So why don't you just touch on briefly kind of the type of accounts that NuView offers, and kind of the differences among those, if you will.
Yeah, I'll start at kind of the top, which is self-direction is really nothing more than picking your own investments. You can self-direct your account at Charles Schwab and TD, where a company like NuView offers its value is we don't just allow you to self-direct, we allow you to self-direct into any asset class. So where Schwab says you can self-direct as long as it's a stock, bond, or mutual fund. NuView says you can self-direct into anything not prohibited. And really, there's very few assets that are prohibited. So real estate, private debt, private equity, all of those things are permissible. As far as the types of accounts, there's no difference between an account you could open at Schwab or an account you can open at NuView. The IRS sets what types of IRAs exist, what the contribution limits, and what the rules are. What differs from Schwab to a NuView is simply the ability to buy assets outside the publicly traded space. So we kind of refer to it as, Schwab helps you invest through Wall Street, NuView helps you invest through Main Street, right? But if you look at the types of accounts, you have a traditional IRA and a Roth IRA. Both of those have a $65,000 or $6,500 contribution limit. Don't quote me on these numbers. They change at the beginning of each year, so I'm not certain if they've gone up a tad. But the major difference between a traditional and a Roth is one is pre-tax, which means you get a tax deduction to put the money in, and you pay the tax when you withdraw it. The benefit of the Roth is you don't get a tax deduction to put it in, but you can take it out completely tax-free. So that's kind of a tax decision you have to understand. Both accounts offer tax advantage growth, meaning your investments aren't taxed. And the point that you made earlier about real estate has inherent tax benefits that you give up in an IRA. Now that's okay. If it's a good deal, it's a good deal. But notes really don't have any inherent tax benefits. So owning them in an IRA is actually very advantageous, because if you have a note that pays you $1,000 a month and you have 12 months of income, that's $1,200 you've got to get taxed on annually as short-term capital gains. Whereas in an IRA, that $1,200 can come in 100% tax-free, no matter what type of account you have. So you're saving that tax and reinvesting that time and time. So there's some big value there. If you're self-employed, there's a SEP IRA, which gets you up to around $63,000 of contributions. But I would encourage you to step over the SEP IRA if you're self-employed into a solo QRP or a solo 401k plan. It is the best type of retirement account. It gives you the maximum contributions. It has Roth component. It has a loan provision. It avoids a certain tax that may apply in IRAs that doesn't apply in the QRP. There's a lot of great benefits to it. So if you are self-employed, that's the plan to consider no matter what you do. Two other types of plans that are really interesting that most people either don't know about or don't know the real value they offer, and that's a health savings account or an HSA. So if you are on a high deductible health insurance program, this is crystal clear advice, go set up an HSA. We're not in the business of it, but it's the only plan that gives you a tax deduction when you put the money in, and it comes out tax-free for qualifying medical expenses. But the purpose of a high deductible insurance program is you're going to be out of pocket for your insurance expenses. So why not start pre-saving for that and taking advantage of the tax benefits? The part that most people don't realize is that HSA rolls over year, so you don't lose it at the end of each year, and it can be self-directed. So you can actually own, a private note or a partial of a note inside an HSA.
So how are those? Because I still work part-time for the federal government, so I did the FSA for a few years there, and I'm sure it's gotten better. But frankly, it was chasing receipts and so much headache to maintain, and then you lose those funds at the end of the year. So I just discontinued use of it. But is the HSA available to pretty much anyone, or how does that work?
So the HSA is only available to those that have a high deductible health insurance program.
Okay.
It is different than an FSA, much different. But an HSA, they work in theory the same way. So a high deductible health insurance program is defined for an HSA standpoint is, I believe it's $1,200 minimum deductible annual, and you're 100% responsible for expenses up to your deductible. So think of it like car insurance. And I kind of, when I talk a little bit about, why people should at least consider it. If you think about your car insurance, you probably have a $500 or $1,000 deductible, because you know that if you go and you bump into something that costs you $80, you're just going to pay it yourself. It's not worth going through insurance. But you raise your deductible to drop your premium. So you want to pay as little per month. Well, you can do the same thing with health insurance. So it basically says, hey, I know that if I get the sniffles and go to the doctor, it's going to cost me $200. Maybe it costs me 50, 80, I don't know the number. And some people are so scared of that. Well, if I'm saving $80 a month in my premium, right, that's $1,000 a year. So I could go to the doctor every quarter and spend $200 and still come out $200 ahead. If I don't go to the doctor at all, right, then I come out way ahead. And God forbid I do have something catastrophic, I lose a little bit, but I am protected, right? I'm going to have a minimum deductible that's going to allow me to cover the expenses. So I don't have to worry about being hospitalized and not being able to pay. I just have to pay my deductible.
Hmm.
So in most cases, if you max out your HSA, you cover and use it after a couple of years of moderate to low use, you probably will never have a deductible issue unless you have constant catastrophic super high medical expenses. So it's a way to win the game. It's like self-insurance. So I could go on and on about the plan. I think they're awesome. I have one. I own notes in mine. It's been incredible. And but everyone's health situation is different. That's the part that I can't speak to. But I encourage everyone, every year you should look at the numbers. And if it's $50 cheaper, maybe it's not worth it. If it's $100, $200, $300, some people, the older you get, getting insurance, I mean, you could save $400 a month by being in an HSA. I mean, I've seen some staggering discounts. So great plan, can be fully self-directed.
That's great. And then you touched on, we spoke earlier about the education plans. Can you touch on those a little bit?
Yeah, so the ESA is kind of like an HSA. So an HSA is a special purpose tax advantage savings vehicle for health, whereas an ESA is a special purpose tax advantage savings vehicle for education. It works just like a Roth. It only has a $2,000 limit on it annually, but you can add $2,000 year over year, and it can be fully self-directed. So, my approach, and I'll give you exactly the thought process that we went through with our 9-year-old is, if we go into a 529, we can put more money in it, but it's state sponsored and it goes into stocks. If we put in money into college prepay, right, we're assuming that he's going to college, which we're not necessarily, saying he should or shouldn't. We're also assuming that we want to pre-buy a certain amount of university, and we're prepaying that expense. It's very expensive. It was like $52,000 to prepay for 4 years. Well, I'm thinking, 52 grand over 18 years, I could go invest that money, even in 8 or 10% notes, which from what I've historically been doing is conservative. I mean, we're talking about $400,000 or $500,000 over 18 years. It doesn't make sense,
right?
For me to do that. So we chose the ESA and kind of looked at it this way: $2,000 a year, $36,000 when he's, plus all the earnings. So maybe it's 50, 60, 80 grand, depending on how well it does. That's enough to go figure out what he wants to do from an education standpoint. If he wants to use it on vocation, if he wants to use it on trade, if he wants to use it on certificates or whatever it is, it pretty much all qualifies. And it can be fully self-directed. So I currently own a note where I own about half of it in my 401k, a quarter of it in my HSA, and a quarter of it in the ESA.
That's pretty cool. Yeah, I can tell you with our kids personally, we put a good chunk into their 529s because that's what you do. Well, actually, to be honest, they were kind of, it was intended, kind of set up for us initially, but then we personally, my wife and I had been funding those for quite some time. And then it's like, now, surprisingly, I didn't predict the pandemic would hit. And, I'm not, so we just put my daughter in private school 3 weeks ago, and it's not a cheap private school. And we did pull out the 10K that you can do now, from the 529 without any penalty, but I would like to be able to pull out more. So she's in an 8th grade in a private school now. And my son likely will need more support sooner rather than later. And I don't frankly see either of them going to an Ivy League school. So the point is, you can't predict what's going to happen. With what you're talking about, you have more control and you have more options. I'm locked in. I mean, I could pay the penalty and get out of it, but I'm not kind of regretting the 529 thing, to be honest with you. But so
you bring up, Jamie, a great point on the ESA, which is it doesn't have to be for college. So, you could, if you've used an HSA, and I'm not beating you up for not doing it, but using your example to hopefully help the listeners kind of understand how this works. But in a pandemic, if you decided that you wanted to put your child in private school, you could pay for that out of the ESA. And it may not just be a pandemic. I'll use the example of my son. I don't know what he's going to do. He loves to play soccer, but maybe one day he really wants to pursue that and wants to go to college on and try to get a scholarship. Well,
Mhm.
it may be worthwhile for us, to put him into a school that has a soccer program or something sooner, so he can benefit from that, use his ESA to cover the cost if we couldn't afford to do it otherwise, where he may not need all the money for college because he may be able to get a full ride scholarship. So
Mhm.
who knows what will happen, and
Right.
and it's all wishful thinking, and but it's still something that the ESA gives you more flexibility in the
Right.
grand scheme of things. And just so you know, too, for listeners, you can have an ESA and still put money in a 529.
You can do both. Okay.
Yep.
Gotcha. All right. What other accounts do you deal with in the world you live in?
That's really it. We could get into some more unique stuff, but that's the 90%, 95% of the stuff that the listeners today are gonna
Mhm.
come across in their lifetimes.
Gotcha. So as far as we touched on the pandemic, and there was also an election recently, congressionally as well as presidential. How have these recent changes affected? I know you said for the most part, it seems like the industry has been unaffected, but how has 2020 affected NuView or the industry as a whole?
Well, let's start with the pandemic, because I think the pandemic and the election have two completely different, behavioral changes from a customer standpoint. From a pandemic standpoint, there was about a 3-month lull in everything, and it really had to do with both, with two things. Because the first was shock and awe around the pandemic as a whole. What does it mean? I mean, it was uncertainty. The world was shutting down, right? States were shutting down, and depending on where you live, it may have happened sooner or later. But it was like, don't leave your house. So
Right.
when that happens, naturally everyone is kind of, like they just are in a hold pattern. No one's moving, doing anything.
Hmm.
The second thing that you had that played into that was you had the market take a significant drop in
Hmm.
March of 2020. And when stuff like that happens, nobody knows what to do. Nobody really wants to sell. So we have some people that sold out, moved out, and said, "That's it. I'm done with the market. Let me get into something else." Outside of that 3-month lull, which again, I think for everybody, we all lived through it. Even as if we were employed, we all felt it. Um, we're at pre-pandemic levels, as we say. All of the activities, transactions, new accounts, processing, everything that we do across the board is at pre-pandemic levels, has been for quite some time. So, what we've seen is people getting back out into the marketplace. I think people see opportunity. People are a little bit, I don't want to say less fearful. That's something that they, from a pandemic standpoint, they're less fearful of the economic risk than they were today than they may have been a year ago. So I think you're seeing all of that play out. The stock market is giving people some sense of hope. The real estate market, I mean, here in Florida is going crazy. Probably, not any different outside the U.S. as people realize, hey, wait a minute, we have money to invest. Let's go put it to work. Shifting gears to the election, elections are always interesting. I'm the first person to say it doesn't matter who's in office. The world's not going to change enough. We the people still hold the power. Whether you liked or disliked the current or previous administration, it doesn't matter.
Hmm.
Why people freak out over it going in and coming out is just beyond me.
Yeah.
It's okay to have an opinion, and it's okay to have a preference, but to suggest that we're going to be taxed to death in this administration, or that we gave too much stuff away in the previous, doesn't matter.
Yeah.
Um,
Yeah. We
you know,
had
that, that's my little sidebar,
no,
but
I agree with you. And we had a guy, Dave Van Horn. I love to quote this, but he's a kind of a big player in the note space and real estate and on bigger pockets and everything. And he mentioned, he's just tell me what the rules are, and I'll figure out a way to win. So,
yep,
he's been doing it for a long time. He's been successful. It's just an example of, it's don't freak out about all these changes. Have your game plan, have your business
yep,
model, and adjust accordingly, obviously. But you can win in all political environments. So
yep.
I couldn't agree more.
And it's been proven over time. I mean, if you go back and look at the history, we've had, left, right, center, it doesn't matter. And we've all thrived in different ways. I think IRAs as a whole, I mean, no one knows what legislation can come out if they'll change stuff. I mean, there's always been discussions about caps on Roths. And to date, for the 15 years I've been doing this, Congress in both sides of the aisle have done nothing but actually make it more accessible for Roths, more accessible for IRAs, raising the limit, adding more, options to plans. So not to say they can't, do a 180 on that, but at least to date, they've been more open about it, giving people that. So I think all of those are positives. I know a lot of people in the real estate market think there may be some tax changes. Some of the 1031 exchange and some of the more favorable tax things, they may, come after some of that from a tax standpoint for certain net worths or for certain numbers of activities, which if they do any of those things, it makes the IRA more attractive, right? Because it just means that you use the built-in tax benefits of an IRA for your deals, regardless of what happens outside of IRAs.
Mm-hmm. So you wouldn't mind it if the 1031 exchange went away?
I would mind it, candidly, because I own real estate,
Yeah.
and I think it's a fantastic tool. I'm all about tax incentive for people to do the right thing. I understand why it's attractive for them to look at it. If you look at the world and kind of say there's a wealth gap, and I'm not saying it's bad. I'm a capitalist, at heart, but I understand why people look at this wealth gap and say, hey, wait a minute. The wealthy are the ones using the 1031s. I mean, that's really
Sure.
it. So, will it crash the real estate market? No.
No.
People will figure out how to sell their real estate and just take their profit net tax, not their profit gross tax. I mean, it really doesn't, it matters, but it won't change people's lives in the grand scheme of things, unless we're talking big numbers.
No, I agree. Would you mind talking about, because we have note investors who prefer to use checkbook controlled IRAs
Yep.
and different accounts. How does that compare with a custodial view on things or administration?
So NuView is a full service custodian. We actually can service what we refer to as 3 different ways to engage in your investments. So self-direction as a whole is about investing into unique assets and picking them yourself. That doesn't change. How you structure that does change. And I share that full service not to make a pitch for NuView, but so that people understand I am as neutral as they come. People that tell you the checkbook is the best way probably sell checkbook LLCs. People that tell you you've got to do it through an IRA self-directed directly are probably custodians that only offer that. But there's also a solo QRP I mentioned that adds checkbook control. So there's really 3 ways to do it. One is to direct it through the custodian. Now in notes, because they're passive, it's actually a pretty easy thing to do, and it does make sense. Generally, if you're buying existing notes, you don't have a time constraint. Like if you send them the money today or tomorrow, you're buying the note, right? And really it's mailbox money. So somebody's got to collect the check and to post it against the account. If there's not many moving parts, it actually does make great sense to do it directly through your custodian, just like NuView. So you would say, NuView, buy me that note. Within a day or 2, we'd buy it. Again, no love lost because it doesn't matter. And we book your deposits each month as they're mailed to us, and you're hands off. So you're going to pay us a fee for that, but you're also not going to have to be responsible to collect the checks, go to the bank, or mobile deposit them, keep track of them, et cetera. That model starts to look less attractive if you're negotiating stuff that needs money immediately. If there's a lot of moving parts, real estate especially has more moving parts, rental properties. That's when checkbook control starts to look attractive. But keep in mind that no matter what, even if you use checkbook control, you still need a custodian. Because what you need the custodian for is to custody the LLC, not the individual assets of the LLC. So that's really what you're doing. You're adding in, if you were to buy 5 notes through NuView, NuView would custody 5 notes. If you set up the LLC, NuView custodies the LLC, and then the LLC holds the 5 notes.
Okay.
So you will save some fees potentially, but you are now responsible to cut the checks, collect the checks, keep track, make sure that you have a fair market value tabulation at the end of the year, that you're keeping accurate records. Because if the IRS comes in and says, what's going on in the LLC, it's up to you, right? We only custody the LLC. We don't custody the assets or manage the LLC.
So there is some compliance benefit to not doing it that way?
Yeah, I mean, it's less work. I refer to it's like mowing the grass. It's not hard. You could do it, right? We're going to probably do it better than you will. A landscaping company's probably going to do it better than you will at the end of the day. But it is like mowing the grass. If you want to save the $100 a month and mow it yourself, go for it. Right.
Gotcha.
But you got to get out and mow it, and you got to go do it, and that's work. And what's your time worth? And for customers that need it, it makes great sense. The problem I have with the LLC model is it's been oversold by companies that peddle these LLCs, saying you have to. And what a lot of people don't realize is, one, you're taking on work. So again,
Right.
just like mowing your own grass, you don't tell me you're saving money to mow your grass. You're not. You're
Right.
trading your time for money,
Right.
and you believe it's an adequate trade. If you believe it's an adequate trade based on our fees and the level of work involved. The second thing is that no one likes to talk about is the LLCs have an annual filing fee in the state that they're domiciled.
Mm,
So
yeah.
California is over $500 a year. It may
Yeah.
not
It's
actually
like,
save you
I think
money.
it's 800.
It's very expensive.
Yeah.
So it depends on what your goal is. For passive investments, it doesn't make a lot of sense unless you're holding lots of these.
Right.
And even then, the fees probably aren't going to save you much when it's all said and done compared to the work responsibility.
Right.
But all of that said, I'm a proponent of the LLC in the right place.
Hmm.
The last way to do it, the third way, is through a solo QRP that has built-in checkbook control. This is the best of both worlds. You get all the benefits of the solo QRP, higher contribution limits, Roth contributions, loan provisions, right? Avoiding the UBIT tax. But in addition to that, a qualified account has built-in checkbook control. So you can go and open your own bank account without an LLC. So the 401k QRP is a trust. So you go to the bank, open up an account for the trust, you write your own checks, keep records of everything, but without the LLC. So you have the same ability, the same opportunity. You do have to keep track of stuff, right?
Hmm.
But you don't have to go through the headache of the LLC, which is expensive to set up depending on where you go and potentially expensive to maintain. So again, direct it through us, great for passive, no problems at all.
Hmm.
Set up a checkbook LLC and we can custody it, and you can go do your own thing inside the LLC, just follow the rules. And then the last thing is use the solo QRP and use its checkbook control built-in component. That's the best.
Hmm.
If you
Interesting.
qualify, that's the best.
Yeah, I didn't even really realize about that third option. That's really interesting. So you mentioned following the rules. Can we briefly touch on what is prohibited with these accounts, whether that's a particular asset class or I know self-dealing can be an issue. Can you touch on what we can't do through NuView?
Sure. I refer to this as the toddler provision, right? And for those of you with kids or with toddlers, you'll understand this completely, which is you really don't tell kids at that age what to do. You're constantly telling them what not to do. Don't touch that, don't eat that, don't climb on that. And
Hmm.
the idea is if I tell them all the things not to do, then they'll kind of understand everything else is fair game.
Hmm.
The IRS actually rules are kind of the same way. So maybe you could say they're treating us like toddlers, but they can't create a list of what we could do, right?
Hmm.
You can't tell your kids, do this, do this. The list is too long.
Right.
So instead, we focus on what you can't do. And there's only two asset classes you can't buy: life insurance and collectibles. The second piece has to do with self-dealing.
Hmm.
To your point, Jamie,
Hmm.
what they're concerned about is it's a tax-advantaged account. These things are incredibly beneficial from a tax standpoint. So what they want to do is put a fence around certain people and say, hey, we don't want people, committing tax evasion by selling assets they currently own to their IRA, right? Think about it. I buy a property for $1 million. I
Hmm.
sell it to my IRA for $1,000.
Hmm.
I get $1 million write-off on my personal tax return, and now my IRA has $1,000 asset that is going to make $1 million tax-free. I mean, you get the idea.
Sure.
So because of that, the IRS doesn't allow your IRA in any way to do business with you or your spouse,
Hmm.
your parents and grandparents, children and grandchildren, and then the spouses and businesses of any of those parties by extension.
Hmm.
Um, you can invest alongside. So, for example, I could buy a note from you tomorrow, Jamie, where my 401k buys 50%, my son's ESA buys 25, and my HSA buys 25,
Hmm.
because each of those are clearly tied to the money that each account had.
Hmm.
I bought it from you, who's an unrelated party,
Sure.
and all of the income is going to be split in the same pro rata. So it's no different than all three accounts owning shares of Microsoft, individually titled.
Hmm.
What I couldn't do, Jamie, is I couldn't buy the note in my 401k from you or buy it personally from you and then turn around and sell it to my individual accounts, because at that point now I'm in control of the price, and
Hmm.
the IRS says we're not going to police it, we're just not going to allow it. So steer clear of family members, stay
Hmm.
passive in your IRA, and keep that major tax benefit intact. It's too important to risk.
So briefly, you said stay passive, and I know you're not an attorney, but or you don't represent the IRS or anything like that. But what might be considered running a business or not being passive in an account like this? For example, I saw this in our Facebook group recently. It was a question about, or it might have been a different group, but selling partials from the IRA, from someone's self-directed IRA. So the IRA would be selling a bunch of partials. And, you know, I just mentioned you might want to be careful at some point, you know, if this really is no longer passive. Where's that line? Do you have any insight into that?
You know, as of today, it's a mythological line.
Okay.
And I don't say that to be trite. I say that because there is not one case that anyone in my 15 years has ever put in front of me ever that shows an IRA being in trouble for running a business.
Okay.
I've never seen it. Self-dealing and running a business are two completely different things.
Sure.
Self-dealing, there are plenty of cases of people getting in trouble. And it's crystal clear, right? Jamie's IRA sold something to Jamie.
Mm-hmm.
You know, well,
right.
There's no issue.
Sure.
There's the reason that people are concerned about running a business in an IRA is it's not going to run you're not going to lose your IRA by doing it. But the IRS could assess a business tax to the IRA for becoming a business.
I see.
Where's that line? Again, I don't know.
Mm-hmm.
It is so, I think it's so difficult to put a number on it. It's kind of like buying stocks. If my IRA goes and buys 100 stocks, is that a business? What if I sell them all the next day? Is that a business? If I buy 20 and sell 2? I mean, there's no right answer. You have the same risk of running a business, i.e. day trading in an IRA in the stock market as you do in the note market. You know, here's where I think it gets to. If it's crystal clear that this is taking over your day-to-day full-time, this is what you do and you route everything through your IRA, the IRA probably could look at that and say, yeah, this may be a business.
Right.
But if you're doing this outside the IRA, inside the IRA, and you're just simply active, they can't penalize you for being an active investor.
Sure. And I know the IRS has certain guidelines with becoming, like, for example, a real estate professional, where if you're, you know, spending 40 hours a week flipping houses or selling real estate, you're a professional and you can get that, which has certain benefits to it. So I would guess maybe people should kind of look at it in that sense. But that's really helpful because, yeah, you know, for those of us who don't kind of like meditate on this stuff all day long, it's like, oh, there are a few things that I know I can't do, some asset classes and some relationships, you know, that you can't deal with, and then also the self-dealing, and then separately the business thing. But in general, even though you definitely went into the weeds there, which was really helpful, it really sounds like that's maybe, you know, 5% of you know, of everything is what you can't do. There's a huge world of what you can do with these accounts, and I don't want to just focus on what you can't do because there's so much opportunity here. Speaking of the opportunity, would you say, I know we briefly touched on the fact that more people are aware of this self-direction in general than maybe 10, 15 years ago, but any idea what the numbers look like from a kind of what percent of accounts are self-directed versus not?
I will start by saying this number it's not pulled out of air, but it's also not fully scientific. Most of the companies in this business are private. Now that said, we know we have industry groups. We know all of our competitors. We're all very friendly, and we have some general numbers. And then also there's some overlap. Some of the assets at Schwab and Fidelity and TD are alternative. They may not be as alternative as a one-off, you know, partial note, but they may be a note fund, $1 billion note fund. And there are a lot of these big investments that do exist, you know, for some high net worth investors through advisory firms. So, you know, the number that we hear is it's definitely north of 5%, probably south of 15.
Okay.
You know, depending on what you consider an alternative. If it's packaged up and sold at the advisory level, some people say it's not really an alternative. It's an alternative asset, but it's not really a one-off deal, so we don't count it. And others say, no, if it's not publicly traded, like it's private, whether it's $1 billion fund or $1 million fund, it's still the same idea. Sure. And they would include it. And that number probably starts to get closer to 15%.
So even if we're talking 10% rough numbers, that's still a pretty small number. I don't know, you know, I'm sure we wouldn't ever get to 100%. A lot of people don't want to take that ownership, and, you know, but some of it is related to just education, like, you know, like we're doing now. Does NuView have events or any type of educational distribution, if you will?
We do, and our, you know, we're with you. You know, we don't expect 100% success. Honestly, If the number was in the 25 to 35% range, I'd probably say that's where it belongs. Keep in mind, I mean, think about, Jamie, just your own experience, how resilient you've probably had to be to get into this business. You've put in a lot of education, a lot of time, and
Mhm.
I'd be willing to bet you learned some lessons and the experience at the same time.
Right.
And so maybe you've been fortunate to learn from others, but there's a lot of people that shouldn't be doing this. And I don't
Mhm.
mean that to be critical, but just
Mhm.
like there's things I can't do in my life and I shouldn't be, and there's things they shouldn't be. So, that number probably isn't north of 35% on a high end.
Mhm.
But as far as what we do, I mean, our goal is to continue to educate. It's been our primary focus for the last, 16 years I've been part of this company, and it continues to be a major focus for us going forward. We are educators on how you can do it and what you can do. That's really what we do. We have educational classes, content, all kinds of stuff all over our website. We do used to do a lot of live stuff. Right now, everything's virtual for obvious reasons. But yeah, take a look at our website at NuViewTrust.com with a U, NuView Trust.com. You can see upcoming events. We do procure a lot of our own content along with third-party content. And yeah, our goal is to help people understand how it works. The nice thing is there's people like you, Jamie, and groups that you guys participate in where they can learn a little bit more of the how,
Mhm.
of the investments. We're really the how of the self-direction. And
Mhm.
we hope our clients are smart and educated. Smart and educated clients generally make good decisions, and that's what we want.
No, that sounds great. Is there anything else you want to throw in before we wrap up? I mean, any other ways that NuView separates how you guys separate yourselves from other custodians or anything like that?
One is education, so that's certainly something that we pride ourselves on. The second is we're full service. We're one of only one or two custodians I know that can do both the directed, self-directed account directly, a checkbook control account if you want it, and the solo QRP if you want it. So you don't have to go buy it from different parties and try to build all these relationships with people that make their money in that only that arena. So that it's not that you're getting bias information, but Chick-fil-A is not going to tell you how good Taco Bell is, right? They're only going to tell you this is all that's available to you. So that's really it. It's we want to educate and more importantly, we want to allow you to serve yourself the way and the structure that you think is best for you, and we'll help support that process no matter what you choose.
No, that's great. I love the fact that you educate, but you're not really. Sounds like you're not really selling too hard. I mean, you're trying to provide options for people to take control of their financial future and take advantage of these benefits that these accounts offer. What's the best way for people to get in touch with you? You mentioned the website. Is that the best way?
Well, that's the best way to kind of learn about our company and understand what we do. And most people start there. My email is Jason, Jason, at NuView with a U, NuViewTrust.com. And you can email me directly if you guys are listening, a question popped up, or hey, you know what? He kind of started talking about this, and I may have gotten this answer, or here's my scenario. Money is personal. We understand that. So if it's something that you have a question about, shoot me an email and I'll get back to you with an answer or get you connected to our team if it's a little more involved.
Sounds great. No, that's fantastic. I think we've really covered a lot of ground, both high level and kind of in the weeds as well. So I think our listeners are going to get a lot of value out of this. So thanks a lot, Jason. Really appreciate your time.
Yeah, absolutely, Jamie. Thank you so much for having me.
Absolutely. Take care. And
All righty, bye bye.
everyone go out and do some good deeds.